Next, we're going to talk about time value of money. The reason why we talk about time value of money in the real estate series is because time value of money is important for the valuation of a property. To understand time value of money, a critical question to ask is, for example, if I pay you $100 5 years from now, how much are you willing to pay today? The intuitive idea would be that you will pay less than $100 today in order to receive $100 in the future. Imagine for a moment that this financial product is paying you $100 in 5 years. How much are you willing to pay today? So the question about how much you're willing to pay today is dependent on what we call the required rate of return. In this case, we have three examples here. Required rate of return ranges from 5% to 10%. So you can see here that by discounting the $100 in 5 years back to the PV, which is the present value, we get the following number, 78.35. So this means that if your required rate of return is 5%, you will pay right now a value of 78.35 for this financial instrument so as to receive $100 in 5 years' time. But if your required rate of return is 8%, the PV goes down to 68.06. This means that you will pay an even lower price. So this makes sense, right? You pay a lower price now, $100 in the future. So that would naturally means that your return will be higher. And likewise for R equals to 10% is even lower. This is the present value, it's just counted back. But how about the future value? So given this current PV, how can I get 100? I'm going to quickly show you. So 68.06, the compound for the first year, compound for the second year, compound for the third year, compound for the fourth year, and finally compound for the fifth year. This will give you $100 back. So this is the way you get the future value is by compounding. And to get the present value, what you do is called discounting. So now let's come up with a more complicated investment product. So let's say rather than I pay you $100 in 5 years' time, what if I pay, say, $100 every year for 5 continuous years? So how much would you pay for this financial product? Before we get into the calculation, what does this remind you of? So you have a fixed payment every year until maturity, and you pay for that financial product in terms of the current PV. So that will be the current price you're paying. What does that remind you of? Does that now remind you of a fixed rate mortgage payment? $100 will be your mortgage payment, and the one at the bottom will be your mortgage rate. Given a mortgage rate or required rate of return of 5%, this will give you a present value of 433. And similarly, if it's 8%, you get a lower number, 399 and 379. So in terms of this PV, so this would be, for example, if this is like a mortgage instrument, this would mean that the bank will lend you $433 now, and you will pay $100 every year until the 5th year. There's another type of cash flow financial product that you pay the PV now and you get the payment forever, which means that maturity is infinity. Using I'm not going to derive it here, but we can use the infinite geometric series to show that the result is just the one payment divided by the discount rate R. And this will result in the price you need to pay now. An intuitive understanding of this is that the reason why you can get paid forever and yet still pay a finite amount of money for this financial product is because that the payment that you get in further out in the future will be worth less today because of the discounting. You can picture this like, for example, if I pay you $100 a million years from now, it's as good as zero, right? Okay, so now we come to the annuity instruments. So like I said before, the previous payment, so the fixed rate payment you have, also called an annuity. So the payments are all the same. The interesting thing about this is that you are actually paying off both the interest and the principal at the same time. So this is also called amortizing loan because by the end of the maturity, you would have paid off everything. Like the loan will be the PV, the price that you pay at the beginning, or in terms of mortgage, will be the amount that the bank will lend you, and you're actually paying it off for the whole term. And the reason why we have amortizing loan in the first place is because, so initially, let's take an example of a typical mortgage loan with a 20% down payment. That means you are having a leverage of 1 divided by 20% is 5 times leverage, right? So why would a bank let you leverage so much? Wouldn't it be very risky for the bank? Like, why would the bank engage in such a risky investment? There are two main reasons for this. The first reason is because your property is a collateral for the mortgage loan. So in case if you default on the mortgage loan, the bank can foreclose your property, right? So that's one of the reasons. And the second reason is because over time, the interest part of your loan will decrease. So this effectively means that your leverage would also decrease. So initially it's very high, but it approaches to zero at the end. You are like 5 times leverage, but as time progresses, your leverage will approach zero. So the bank is only taking like very high risk at the beginning, but at the end, it's not taking so much risk. So your leverage is not constant. Unlike a REIT, where the REITs will probably not take a mortgage loan, but they will issue bonds, the level of leverage will be most likely constant. So even though they do not leverage as much as a mortgage, but their leverage would not change very much because most of the loans that the REITs take are not amortizing. So how do we compute the payment for each period? So the payment is constant, right? We are just assuming a fixed rate mortgage for the whole duration of the loan. There is a formula we call annuity cash flow formula that you can use to calculate the payment. So A is the payment, R is the interest rate, and the PV is the amount that the bank is lending the money to you. And to derive this annuity formula, you can use the infinite geometric series. We actually done a video in the fixed income series on how to derive this equation. But we're not going to do it here. Let's look at an example. An investor seeks a fixed year, 30-year mortgage loan, right? So to finance 80% of the $1 million purchase price. So the bank will loan 80% of the $1 million, which would be 100,000. So you are putting a 20% down payment. So calculate the investor's monthly payment or the monthly mortgage payment if the annual mortgage is 5.25%. The thing to take note is that you have to divide the annual mortgage rate by 12 because this is the monthly, this is an annualized rate. And because you're only borrowing 80% of $1 million, you need to multiply by 80%. And similarly down here, you have to divide it by 12. And because it's the 30-year loan and each year there's 12 months, so in total that's 360 months. And we get a monthly mortgage of about 4.4K. Okay, let's look at a mortgage schedule here. This monthly payment column is the mortgage payment that we calculated earlier. So the beginning balance is that we borrow 800,000. So the idea is that you pay this off at the end of the term. So the beginning balance is 800,000, and at the end you pay off everything. So the interest payment column is the interest on the remaining principal. So let's take a quick calculation. Percentage is 5.25. So divide by 100 and divide by 12. You get this monthly interest. And if you were to multiply this by the principal that you're borrowing, the loan amount, so that will comes up to 3,500. So that will be the interest part of your payment. But remember that we calculated that your mortgage payment is 4,417 each dollar. So we have to deduct find the difference, 1763, because you're paying more than the interest, right? For the loan. That means about $917 goes to the principal. So you're paying off this principal part. So you have to minus it from the current loan that you have. So from the current principal, so you left the remaining 799,082.37. So this is the remaining balance. So you carry forward the remaining balance to the next month. So now, because you're calculating the interest on a smaller principal, your interest rate will decrease. We will see how this is done. So 0.0525 divided by 12. This gives you a new interest payment of 3,495. This is the one here. So you can see that the main thing you need to note is that the interest payment actually went down because you are calculating the same interest rate on a reduced principal. So you get the principal repayment part, right? So 3,495.99. So this gives us 921.64. This is the principal repayment. So we need to subtract this from this. So 0.82.37. Okay, so now we left a remaining principal. So we just keep on doing this, and until the DF year, it will get to 0. We just quickly show this. Okay, see that the remaining balance has now approached almost to 0. So this will give you a very low interest, right? 0.0525. So you divide it by 12. That's monthly interest. So you only pay 19.24. I mean, on a mortgage payment of 4.4K, this is effectively almost 0. So you minus 4,417.63. This gives you principal payment of 4,398.37. Right? So subtracting this, you get a final value of 0. So it's, this loan is fully amortized by the 30th year.